Glenn, global equity markets have been up every month since November last year, in fact, but they were flat in May. What then in particular did we see last month?
Yeah, look, I think May was a pretty significant month in markets. We have felt for some few weeks now that markets needed a period of consolidation. As you say, Richard, we've had 7 consecutive months of rises in markets. Since the middle of last year, markets are up by between 25 and 30%. So we felt they needed a period of pause and consolidation. And that's indeed what we're now in. Developed markets were flat in the month, emerging markets down again in the month. But I think the really significant thing that happened this month, and maybe we'll look back on May as being a very important month in the evolution of this whole long sort of bull market that we're in. The really important thing was that we saw the first evidence of how markets will react when there is some form of tightening of this ultra-loose monetary policy that we've seen around the world over the course of the past 3 years or so. So it was a very significant month in that respect, and we saw some really, I would describe them as major moves in individual asset classes during the course of the month.
Could you just give us a bit more colour on those moves?
I probably should, yes. Essentially what happened as we went into the month is that the minutes of the Fed's meeting end of April, early May were released and showed some members of the Fed's committee in favour of a relatively early tightening of ultra-loose monetary policy, and that means reining back this huge scale of asset purchases. And that, in combination with reasonably good numbers out of the US economy, which continues to do, I think, better than most people thought it would do at this stage, those two things combined led people to start to focus very much on a reduction of liquidity in markets. So what happened? Well, first of all, we saw Treasury yields, the 10-year yield moved up by 0.5% in the month, a big move. So that was a 2 or 3% negative return from that asset class. That spread across all safe haven government bonds. So global government bonds produced a return of negative 3% in the month, a big number. More importantly, the impact on the dollar. The dollar was strong. Emerging market currencies came under a lot of pressure. So, for instance, most Latin American currencies fell by about 6% in the month. The very bottom of the pack was the South African rand, which has got a particular problem with labour unrest, down 11% in the month, big moves. Emerging market currency debt, which has been a very, very strong performer, seen huge inflows of money, quite a big setback in the month, down over 4%. So suddenly a sort of a turn in the tide on some of these things where we're seeing huge inflows of assets. And generally, I think what we've got is a sort of a mini bout of liquidity contraction, not because there's been any tapering of asset purchases yet, it's just the discussion about it. Even within equity markets, there's some quite significant moves. Those sectors that have seen big inflows because of dividend flows, what are perceived to be good dividend income stocks, came under a lot of pressure. So property securities, REITs, down nearly 8% in the month. Utilities, telecoms also coming under some pressure. So this was pretty much across the board the impact within equity markets and certainly across bond markets, a very significant impact of this change. And this, I would emphasize, is not a question of tightening policy, it's a question of the market beginning to worry about policy being tightened.
We'll get on to Japan, no doubt. I was wondering if you had a comment on Asia excluding Japan.
Yes, well, Asia excluding Japan, the indices tend to include Australia typically there, and the Australian currency had a big knock in the month, down nearly 8% in the month. It was caught up in this whole commodity cycle that we've talked about in recent months. We've seen the commodity markets going down further. We continue to see that. Of course, Australia is a heavily commodity-dependent economy. They actually cut interest rates in the month in Australia. And the currency came under quite a lot of pressure. That impacted on returns from the whole Asia ex-Japan region. China, funnily enough, was actually up a little bit in the month. Most other Asian markets were down a bit, and some currencies also under a bit of pressure. So we had overall a big underperformance from Asia ex-Japan, down about 9% in the month, whereas the US, UK, Europe were both up about 2%. So we're all up about 2%. In the month. So there was a big difference in returns. I think some of that as well reflects the fact that the economy in China, as we've said now for several months, is slowing down. There's no doubt about that. It cannot sustain growth rates above 8% on a long-term view. We had the IMF finally revising down its forecast to below 8%. The numbers coming out of China have been sort of fairly disappointing at the margin. And all of that is putting pressure downwards on the Asian markets.
Shifting focus, one to Europe, two to, let's say, economics. How is the situation now in the Eurozone?
Well, the Eurozone situation has improved dramatically post-Draghi's speech back in July, and the tensions have largely come out of the sovereign bond markets. Spreads have narrowed dramatically, and even though we had this backup in yields, which we did indeed see in Europe, peripheral bond markets in Europe actually performed reasonably well. Believe it or not, we even had a situation where Greek sovereign debt was re-rated during the course of the month upwards from a triple C rating, which is complete junk. It's still below investment grade, but it's on the way back up. So some sort of positive indicators. The economy remains weak. Q1 GDP was a negative number for the Eurozone, -0.2, the sixth consecutive quarter of negative numbers. This is pretty serious. But I think we're seeing the first signs of some tentative recovery coming through in Europe. As we go through this year, I think we'll begin to see a little bit more of that. Germany continues to be performing reasonably well. Their industrial production figures that came out in the month were quite good. But we also saw, I think, a significant move from the EU, which is that it relaxed slightly its austerity conditions for a number of countries in the Eurozone. They have a 3% fiscal deficit target. They've given a number of countries more time to reach that in return for further labour market reforms. I think that's a reflection of the politics, with youth unemployment very high, populations getting a bit disillusioned with deep austerity. I think we're seeing some easing off there. All of that suggests to me that we'll see Europe beginning to improve as we go through this year. And as a stock market, it looks quite interesting because it's not been a great performer relative to other markets in recent months, and the valuations look pretty good.
Abenomics, Glenn, has been a key theme this year, with volatility coming through in both the equity market and obviously in the yen at the end of last month. What is happening?
Well, we've seen two of the three arrows sort of pulled so far. One, we've had fiscal spending. Two, we've had the Bank of Japan massive quantitative easing program that we talked about in the previous month. All of that pushed the markets to very, very high levels. They were clearly due a correction, and indeed what we saw was a correction in the course of the month. Japanese market down 3% or so. It only started though later in the month, and it started with a 7% fall in a single day. Remember, this market had been up by 50 or 60% in 6 months or so. Clearly overbought and needed a correction, but there's certainly room in the short term for a bit of disappointment with Abenomics in Japan. The next announcement that is due is for the structural reforms, which is the third arrow of these big changes that are going on in Japan. I suspect there's going to be room for disappointment there, quite frankly, because we've looked for reforms, structural reforms in Japan over 2 decades or more, and they've always disappointed. I think this government's got a much greater intent and much better base of support to push things through, but I suspect, given where markets are, a bit of room for disappointment. So I think Japan could well go through a further period of consolidation, but make no mistake, this is for real what is happening in Japan. This government is absolutely committed to making changes. We've got this huge quantitative easing program going to go on for another couple of years. So this bull market will resume in due course in Japan, but we're just going through a period of pause, consolidation, setback over the course of the next few weeks, possibly 2 or 3 months.
Let's keep moving. Quick comment maybe on Turkey.
Oh Lord, Turkey. Well, Turkey is one of those very difficult situations. You could never pick what's a political unrest going on there, of course. Very difficult to pick that from the outside looking in. I think the concerns are that the government is moving in a more sort of fundamental Islamist direction. Turkey, being a secular society, is resistant to that, so we've seen quite a significant amount of rioting going on over the past week or so. Bond yields have spiked upwards, equity markets dropped 15% or so in the past few days. Look, it's going to have no significant impact on the global economy, global stock markets. but of course it's another slightly worrying factor. Given what is happening in that region, we tend to ignore it, possibly at our peril, what is going on in Syria and surrounding countries. It's a worry. It's one of those geopolitical risks that is very difficult to assess, but it certainly has the potential to do some damage if it spreads more widely. I don't see Turkey being in that situation. I think they'll get this thing under control. But of course it happened in a month when emerging markets generally were coming under quite a lot of pressure, so not very helpful, although I don't think it's what I would call a sort of substantive strategic development in markets.
In summary then, a change in Fed talk, possibly being to heighten volatility at the end of May. What do you see to come in the short to medium term?
Yeah. Well, I think you're absolutely right saying that the key thing this month was undoubtedly the change, as you were saying, in Fed talk, the market's perception of when there's going to be some tightening of QE. The thing to emphasize here is that what the Fed is talking about is some tapering of asset purchases. Bernanke made a speech during the course of the month where he made it very clear that the Fed would not go onto autopilot. It wouldn't just say we're going to cut by 20 billion a month for 3 months, that's it. We'll remove all quantitative easing programs. He's made it very clear they'll do a little bit. Maybe they'll cut purchases by 10, 20 billion a month out of 85 billion. We're still talking about huge amounts of money going in. And he's also made it very clear that they will judge the market's reaction to that and how the economy is performing. They'll watch that very carefully. So this is not just turning off the taps completely. It's the beginning of a process. My guess is it won't happen for a few months yet. I think the economy, yes, it's improving. There are some quite positive areas. Housing we've talked about in the past. Consumer confidence moved to a 5-year high in May, but manufacturing remains weak. And there are parts of the economy that remain under pressure. We know that government spending is under some pressure. So all of that suggests to me that it'll be further down the track than the market is currently thinking. But the important point is that we are going to see in due course, within the next probably 6 to 9 months, some tapering. We've seen an indication of what might happen to markets. In the meantime, there will be tremendous liquidity support for markets. So I think what's going to happen, we'll go through this period of consolidation, markets pulling back a bit, long overdue. I think it's a healthy correction. I think the bull market remains intact in equity markets, but you've got to worry about your bond holdings. The fact is that as asset purchases are removed, next stage, a couple of years down the track, interest rates go up, economy is doing better. That will not be a good environment for bonds. And of course, we've seen how bonds react. They get much more damaged by the talk of tapering than equity markets have done. So a period of pause, consolidation, setback in markets, healthy. I think the equity bull market will resume as we go through the latter part of this year. But the bond holdings, one needs to be very careful about in portfolios now.